here's some good news. Okay, this is from my own experience as well as studying millionaires and billionaires. Right. Here's what I know. I know that if you do okay in the winter, you will do very well in the spring and summer. Everything goes through seasons, right? And the economy and investing in real estate is no difference. Before COVID, like you said, it was like summer. Summer was red hot, right? It was crazy. People were like, oh, the market is too hot. Then all of a sudden COVID hit, came to a screeching halt. All of a sudden it was like Arctic freezing cold. Oh my gosh, it's too cold right now. Maybe I should wait till it warms up. And then within months, it warmed up. You're like, oh, it's too hot again, right? And so I think what happened is for years, probably since I would say 2015, 16, the market really was on a tear. I mean, you couldn't screw anything up with real estate. And so it was this really long summer, and all of a sudden COVID hit and there was this volatility, and we skipped the fall and landed right in winter. So I think we're in winter right now. You can argue whether in the beginning, middle, or towards the end of it, but I think we're in a recession right now. And a lot of people would agree with that. Some people say, oh, well, we're not really in a recession now. But if you look at the numbers, you see various indicators that in hindsight will look like a recession. For example, housing prices are falling. It's due, of course, to interest rates going up. But more importantly, the inflation has been a major problem. And how do you know this is a major problem? You know it with things like, for example, credit card debt. Credit card debt is literally this month going to cross the highest ever personal credit card debt in the history of the U.S. world. Okay, so the highest. Why? Because people are using their credit cards to pay their bills, right? At the same time, savings rate is literally at a record low, which means that people have depleted their savings rates and are now going into credit cards. If you look at the jobs report, if you study it really great, all these jobs are getting created. But if you look at the fine print, it's actually not new jobs being created. It's people taking second jobs. Why are people taking on a second job? It's because they're not making enough money in their first job. And that's why jobs are being created. But that's not a sign of a strong economy. That's a sign of a very weak economy. And so people are getting squeezed on their expenses. And as a result of that, the demand is down somewhat. The retail spending is down, which is why you see some retailers like Amazon laying people off. Sure. But there's also some tech companies laying people off. What does that have to do with anything? And the reason they're laying people off is because the stock market's down and the cheap money has stopped flowing. Right. So cheap money was used to finance expansion. That's gone. We can't use that. Then they also use the stock market. They would stay with their stock. They would sell their stock to finance growth. Both of those are gone. Now they can't finance growth. They're like, oh, crap, we're overhired. I got to let a bunch of people go. So to me, that's a recession. Right. And so I think that things are going to get worse before they get better. How much worse? Hard to tell. I don't think they're going to get catastrophic, but it may get worse before it gets better. But here's the good news. Okay, this is from my own experience as well as studying millionaires and billionaires. Right. Here's what I know. I know that if you do okay in the winter, you will do very well in the spring and summer. And so because of what's going on, I'm convinced that we'll have more new millionaires in the next 5 years than any time in history. That's where I think we are. I think we're in winter right now. And what we need to do is we need to survive that winter so it sets up to thrive in spring.
Yeah, I would agree with that. I think we're in a place now where there is that uncertainty, there is that the fear that's looming. People are a little not sure exactly what to do as far as us purchasing, and which is a part of our plan is to continue to acquire properties and set up the right game plan for that property, no matter where it's at in the cycle. That slowdown happened at the end of last year. So we didn't even do one deal through the whole end of last year. We just recently got one, and we'll talk about this in a bit, but it's the first sign of like some real value that we can pull out of the situation. So Drew, anything else to add?
Yeah, I mean, we've had a great run of it for the last few years, and I think that we've had this huge turmoil. Michael's calling it winter. I think that's an apt analogy, and everyone's taking a little bit of a pause as far as where things are going. And these things all do come in cycles, right? So I think in this compressed time where we're noticing that we feel like we're in winter, it's important to remember the long-term trends of real estate, what it's done over the decades for people. I keep that in mind. So yeah, we're looking at the short-term things. We're always watching rent increases, what's happening for occupancy in our markets. We're looking at the cost of labor and the cost of material because that influences our construction. So we're keeping an eye on all those things and having it impact our models and how we look at deals. But we're also keeping track of those long-term things. Where are people moving to? Where is their job creation? Whether it's some of the weak job creation that Michael was talking about, or some of the stronger job location, where are Fortune 500 companies putting their headquarters, and that's driving our investment decisions. And the good news is, on the long-term trends that we're looking at, those things still remain really strong. Household formation remains really strong, and so our core thesis in apartments hasn't changed, but certainly it does feel like a different environment than what we were looking at 1-2 years ago. And it pays attention to be looking at those things to know how to be nimble and operate in this new environment.
You said look at some of the short-term trends versus longer-term trends. I want to look at the longer-term trends in a second, but short-term trends really affect deal flow, right? How do we get deals done right now? So can we talk about what are we looking at right now, and how are we underwriting deals, and how are we getting deals done right now in a rapidly changing environment? What are some of those drivers and variables, and maybe some guidance around how people should underwrite deals right now?
Yeah, I think so. Right now, a lot of people are switching. So we had this period of time where everyone was competing using bridge loans on their deals, and so these are variable rate short-term loans with typically high leverage. And so you're seeing a lot of those coming to expire right now, and it's problematic for some operators, especially if they're not in a position to refinance or sell or anything like that. So as far as new deals go, there's definitely, you can't get debt that's over typically 65% leverage on anything substantial that's going to be a fixed rate long-term play. And a lot of people are looking at those types of loans for security, unless you have a real deep value add asset in which you're going to hedge against the risk that is affiliated with bridge debt loans. So in the way you do that, it's just buying a really expensive cap.
So debt is the major, I think that would say the major difference between now and back in March, right? If
I had to point to one thing, it's debt.
Yeah. So what happened, guys, is really what happens though, because of this inflation, this fear of and rise of interest rates, it created a lot of interest rate volatility in the debt markets, and of course, when volatility increased, the level of fear and uncertainty and risk goes up. So what the lenders did is they just chopped the LTV. So before we were getting 75%, 80%, we were through bridge loans financing part of the construction, and all of a sudden they collapsed to like 55%. And so it put the entire industry to a screeching halt, because if you can't have 70% LTV, let's say, you can't pay the same price. You got to raise more equity. And so that's why there was a giant price collapse that was really happening early on. And so how did we overcome that, or how are operators going to overcome that? What's happening now?
Well, go ahead, Drew.
Yeah, no, there's a couple things you got to do. So first of all, there's a little bit of a standoff between buyers and sellers, right? So the sellers, there's in their mind, they still have fixed the numbers from early 2022 when they could get, make it out $50 million for an asset, right? But when the cost of debt has doubled, buyers can't pay that and get the same returns. So something's got to give, right? So if either the buyers have to have lower expectations of their returns, or the sellers have to come down on their prices, or a little bit of both. So we're seeing that adjustment happening in the market. And as Garrett said, people that have properties where their interest rate caps they're expiring. It is a little bit of a complicated process, but basically the financial markets and their debt position, how they structure their deal, is driving them to sell. They have to sell. And so there is going to be a flood of deals coming onto the market in the next 12, 18 months. And so for those buyers that have the capital and know how to underwrite well, they'll be able to survive that situation. But
explain that. Explain what's going on right now, because this is part of the opportunity that we're starting to see. It's not quite here, but we're starting to see it. So explain all that interest rate cap, rising interest rate. How does that affect the average operator?
Yeah. So first off, there's an amazing article in the Wall Street Journal today about this. It said rising interest rates hit landlords who can't afford their hedging costs. And so think about it like this. Let's say you get 5 or 10 year debt on your on your property. So you have a mortgage essentially of 10 years. But you have a interest rate cap on top of that mortgage, and that cap can be as short as 18 months, 24 months. And that's the real thing we're talking about. So even if you have a 10-year mortgage, if you have a 2-year cap, what that means is after that cap expires, the interest rates, as they fluctuate, you're no longer covered from that fluctuation. You're paying the full increase in interest rates. And that's going to mean for those owners that aren't fully hedged on their interest rates that are floating, they're going to start paying double in what their debt service is. On top of that, even before their interest rate cap expires, their loan servicers are going to say, hey, in 12 months, your cap's going to expire. We need to start escrowing money to buy a new cap now. And that used to be, it obviously depends on the asset, but it used to be, let's call it $1,000 a month. And that same $1,000 a month is going up to $3,000, $5,000, $10,000, and putting tremendous financial pressure on that apartment building. So that's the mechanics that's going to drive a lot of opportunity for buyers in the near future.